talking about today, and I guess without further ado, we will get into today's segment. Diversification, how to reduce portfolio risk. This is essential really to every type of trader, all the way from the most passive investor to the most active futures and options trader. Diversification essential. It's a big word. It's multisyllabic, in fact, and thus it scares a lot of people away. But this is truly one of those ideas, Mr. Butler, that once you see it practically done, like we're about to show you here today, it's so simple. It's so easy. And it's funny that this idea, it really occurred to me, and the inspiration for today's show hit me on Saturday night, Sunday morning, I guess, Chicago time, around midnight, 1 a.m., hanging with a couple of friends. Hey, Frank, crypto's crashing. What the heck is going on? And I go in there and I look, and I got out of crypto investment when Bitcoin got up to 55, 58, got out early because it got all the way up past 60. And I've been looking for another place to get in. I've been looking for some two-sided action to get in. And so I'm like, okay, great. I'll go in there and I'll buy not only Bitcoin, but ETH and Cardano and CRO, the crypto.com coin, and Solana, and a couple of these other things. And my one buddy is like, he's taking this, Mike, as an opportunity to liquidate all of his other coins and focus on Cardano. He's like, Cardano's down huge. I'm just going to get out of everything and get right into this one thing. And I'm like, friend, what the heck are you doing there, man? Because all these things, as we're about to see here, we're going to take it to stocks, commodities, interest rates, and otherwise. Stuff recovers in a different way, and you really have to be diversified no matter what your play is: long, short, options, futures, spot markets, whatever it is. It's essential, right?
Mm-hmm. And especially with a space like crypto, I think it makes a lot of sense to be diversified, because as this space grows, you're going to see more demand funnel into these different microcosms of what they actually do. So Ethereum is largely described as the more like the software side of crypto, where the Bitcoin is the mother of all buy and hold investments, where you expect it to go up in price over time because of the limited supply, et cetera, et cetera, et cetera. So figuring out how you can diversify within the sector is 100%. I'm on board with that. I think it makes a lot of sense, which is why your one friend is, trying to just go to the moon, most likely with his one product. But you take a lot of risk in that, because you don't know if Cardano is going to recover as quickly or at the same time as maybe some of these other ones.
Listen, we're all trying to go to the moon, okay? Everybody is trying to get to the moon. Space has never been more in vogue than it is right now. But on your trip to the moon, there's going to be a couple crashes like we've seen over this weekend. And the case for diversification is simply reducing the volatility of those crashes. Yes, we want in a perfect world, Bitcoin at 100,000, ETH at over 10,000. All these things are really going to the moon. And also your stock investments are the S&P 500 up to 5,000. All these different things that you're buying and holding, we want them all to go to the moon. But if you focus in one of them, you don't see the returns of these other markets, or that rocky path to the moon gets even rockier. And so that's why diversification at its core is just the idea of spreading out, what you're buying, or in options, what you're selling or buying, or whatever you're doing in options, futures, and otherwise, spreading it out across that asset class and other asset classes, so that rocky path to the moon is smoothed out a little bit. And I want to show you, Mikey, I know that you know this, but for the audience, I want to give a great example, which was the early part of 2020 here. Volatility shot up huge. S&P 500 got to volatility levels we hadn't seen in years. Now, when volatility rises, and this is just the stock market, Mike Butler, correlations tend to +1. And maybe you can explain to people what that means in the stock market, but also in markets at large, when the stock market falls and volatility gets to, these elevated levels, and we're kind of we could be on our way there, or this could be a blip that we're looking at currently. But what happens to those correlations? What tends to happen to the market at large within stocks and without stocks when volatility rises?
Yeah, I think it's a great thing to be aware of and understand. But really, I like to think of it as like the human aspect kicks in, right? Because when things are normal, quote unquote, you'll have your correlations, you'll have your slight correlations, you'll have your strong correlations. Like the E-minis and the NASDAQ are strongly positively correlated. Except for recently, you've seen some disconnects day to day where the NASDAQ might be down, where the E-minis are up. Even today, the E-minis were up like 50 and the NASDAQ was down 20 at one point. So you'll have your disconnects day to day. But when you see this huge spike in volatility and implied volatility, this is likely also when your news networks are talking about volatility and the VIX as the fear gauge. And when everything is crashing, people start to get fearful. They start to sell out of their positions. And that just adds pressure to the downside, which helps the VIX kind of spike up in this abnormal way. But this applies to all asset classes, where you'll open up your portfolio and everything will be red, even if their correlations were negative. Where if you were trading something like the E-minis and you were trading against that, thinking that you might see some product rallying, but everything is just aggressively red, except for, of course, the VIX, which is almost always going to have that negative correlation, where if the market is really selling off in a big way, then you should expect to see the VIX spiking in a huge way.
Absolutely. And you can see here the same point in time pinpointed. And this isn't a multitude of stock markets, Mike. This is crypto there in the green line. That's Bitcoin. The purple line is SPRE. That's your gold and silver futures there. The blue line, that's your crude oil. And then S10Y, that's your interest rate market. And this is always interesting to me that these markets in a crash, in a downturn, when volatility increases, these things, you tend to see everything on your board almost red, like you say. And it's usually this idea of, what's bad for stocks is bad for most markets. And like you say, stock market moving lower, I've got investments in stocks and gold and interest rates and these other things. And if I'm selling out of one, I'm likely selling out a multitude of them, because the fear, it takes a very rare occurrence for fear to be exclusive to one asset class. Especially if you're seeing it in equities, it's likely being seen in all of them. But what's really interesting to me, and a lot of people might take this information and say like, well, then why would I diversify? What the heck's the point if everything is going to tend to crash together? Well, many people live by what I think is one of the smarter adages, which is like, when the market is feeling greedy, that's when you get fearful. And when the market is fearful, like it was in early 2020, that's when you get greedy. And that's when you tend to jump in. I'm not usually someone who's liquidating amid a crash. I'm usually someone who's liquidating on the ride up and looking for entries in the crash. And this is what's really interesting to me. And this is where diversification kicks in huge, because markets recover with a near zero correlation. I mean, look at all of these markets in the early part of 2020 are falling hard and falling together. Since that early part of 2020 to now, the recovery is, I mean, it's almost split around zero. You've got three of these markets that we're looking at positive, two of them negative, one a really big outperformer. And this is why on that way down, you don't just buy as much of one market as possible. You've got to get a multitude of markets, because I mean, you don't want to miss out on the upside of the one or two that are outperforming, and you don't want to be sitting in the one or two laggards, right?
Yeah. And I think this is especially important, like you're saying, when the dip has happened and you're trying to get exposure to an upside move, you're never going to know which one is going to be the one that takes off. And even if you're flat on like the SM75 or oil, let's say you've made a little bit back after buying in at the lows or near the lows, if you weren't involved in Bitcoin, your portfolio is going to look very different than if you had just been in oil or just been in the 10-year. And this is why this diversification can help you be a part of whatever product tends to or ends up being the big recovery in a short amount of time.
And we're going to get to this week's version of this because it's not, I really don't want people to have the takeaway of like, oh, well, then screw diversification. Frank and Mike just showed me the cheat code and I just buy Bitcoin when it crashes, because what we're seeing actually today is a very different story. And the story is going to be different every single time you see a market crash. The story today is, big market crash last week and this weekend. And what's recovering best today? Well, it's actually the SM75 stock market and crude oil and interest rates, metals and crypto, the two best recovering asset classes from the 2020 crash, are actually recovering the worst here in the latter part of 2021. We'll get to that in a second, but I just want to hit people with this graphic, which is really essential to understanding why we diversify. Because yes, of course, if you're long one market that is the outperformer of the bunch, buying 4 other markets and divvying up $100 into 5 $20 shots is going to underperform. Yes. But what you lose in returns when you are diversifying, you make up for, and we've shown this time and time again, you make up for more than 2, 3, 4-fold in your reduction in risk, your reduction in standard deviation. And it's this idea of, I got $100. Instead of going to one market, I'm going to go to 5. Yes, 1 or 2 of these markets aren't going to perform as good as one of them might have, but my portfolio is going to see much smaller variance on a day-to-day basis. I mean, this is essential to portfolio construction, right, Mike?
Yeah, and I think this is especially important if you already have a larger account and you're trying to preserve that account. If you have a small account and you're trying to multiply it, then sure, if you want to try and go long one market, especially if you feel like you have a feel for a recovery or potential recovery, then sure. But if you already have a larger account, then 100%, I think it makes a ton of sense to be able to expose yourself to these multiple sectors and have the ability to catch. If one of those does go off, you're going to be a part of that. Whereas if you're just picking one, you have a 20% chance of hitting it correctly. Even if whatever you believe is your strongest opinion you've ever had, that doesn't mean it's necessarily going to take place and come to fruition immediately.
That's exactly right. You're still a part of that upside, especially if the upside is as great as we've seen in some of these markets. I mean, the short-term interest rate market, that one's up hundreds of percentage points this year. It's not just crypto that can do this thing. And so you're going to be a part of it if you diversify no matter what. It's just a matter of 1 or 2 of my investments are up huge, and that is making up for the other ones here. And I'm still, net up a lot on the year or whatever time frame. And I've reduced my standard deviation because everybody thinks they know the market, myself included. Everybody thinks they know the market that's going to outperform. But the story is different every single time. And that's actually a good segue. We have some time left. I want to pull up the platform and just look at how different the story is here in the latter part of 2021 relative to what we just looked at in the early part of 2020. You're seeing here, and I'm just looking at my watch list. I'll actually pull up here on the recent symbols, the different markets that we just looked at. I got Bitcoin, the 10-year, I've got crude oil, and I've got the SM75 market and the SPRE market. And so these are the same 5 markets that we were just looking at. And look at here. I mean, if you just bet on the one market, Bitcoin being the best recovering asset class, crypto being the best recovering asset class from the last week or so of market crashing, you're down 8.5% here today. And if you did diversify, though, to all 5 of these simple markets that we put together, your Bitcoin, your precious metals with the SPRE futures, your stock market with the SM75, crude oil there, and interest rates, your 20% of each of those, you're up, even though Bitcoin is down huge still. I mean, look at this interest rate market bouncing back to the tune of almost 7%. So this is just, again, Mike, like if you had asked me last week to rank these 5 asset classes and be like, which one's going to recover the best? I would no doubt be wrong, but that's what diversification gets you. It gets you a piece of the upside without having to know the exact story, right?
Yeah. And I think that's the biggest thing, being able to have a small win if you're diversified. And really, you could also think about it as a great opportunity, because if you're net positive being exposed to all 5 of those sectors, and you also see that Bitcoin is just getting destroyed today, well, you're still going to be long Bitcoin if you change nothing. And if the rest of those sectors are flat, let's say tomorrow, and Bitcoin rallies $5,000, you're still going to be a part of not only the profits that were offsetting your losses in Bitcoin, but now if the rest of them are flat and Bitcoin recovers, you're getting that extra bonus potential profitability, where if you were just in Bitcoin, you're seeing that 8% loss today, you're seeing the 8% gain tomorrow, and now you're just at a scratch.
Exactly right. And you know, I wish, of course, I don't want anybody to lose any money at any point. And I wish my buddy all the best. But like you really just to have it is like a human nature trick that your mind plays on you, which is like everything is crashing, everything looks like crap, but this one really looks like it's going to be the best moving forward. So I know I should diversify, but I'm just going to buy this one thing and ride that thing to the moon. And it's like the story's going to change every single time. Like every time, the recovery, the crash, all these things are going to be different. Last year, you know, tech and crypto, those asset classes, they recovered the best. Here, amid this crash that seems to be at least tangentially related to still, you know, the pandemic and its effects, again, here in the latter part of 2021, you're seeing crude oil and the stock market. SM75 has energy stocks and financial stocks and a bunch of other sectors in there, not just technology like the NASDAQ or what have you. The recovery is looking very different. And it's just an example of like, everybody has their own opinions, everybody has their own research and everything else, but diversification is such an age-old idea, and it's so essential to portfolio building, options trading, futures trading, everything else. Because at the end of the day, something is going to, you can read all the news about the last week, Mike Butler, you could read all of it, everything about crypto and every single asset class. Something's going to happen in the next 24 hours that's going to change the story of what you thought was going to be the recovery here. So I always advocate, especially if you're just constructing a portfolio or you're looking at this crash in a bunch of different markets as an opportunity to buy some things. Or from your perspective, you're looking to add short options trades as volatility climbs. You always want to spread that out across the different asset classes here and try to at least get close to having, you know, semi-equal positioning in the different asset classes, because who knows what's going to happen tomorrow. But with diversified portfolios, you've at least reduced your risk of what's going to happen tomorrow.
Yeah, totally. And you can do that endlessly. We've talked about that on this show before, where we were looking at getting long the SM75, I believe, and getting short Apple. So like playing into that hedge across asset classes where you are still getting long this product, you're getting the static delta by way of the small exchange contracts, but you're also seeing that Apple is one of the bigger outperformers of the sector. So you're getting short in a small way, you're hedging that position, but you're getting long the core components that you want to. And, you know, that's just another way you can think about this. If you think about this total umbrella with all these different pieces flying up and down within the umbrella, you can pinpoint which ones you want to be short, which ones you want to be long, and get even more detailed from a hedging standpoint that way.
That's exactly right. Like it's the scenario of within stocks, for instance, great example in the last week or so of exactly what you're talking about, where like everything is down, but tech is starting to get hit a little bit more than energy stocks and industrial stocks, and airlines are actually outperforming here today. And so like on the way down, I'm going to buy each of them. I'm going to buy STIX and I'm going to buy SM75, STIX being the technology futures and SM75 being the broader market. And then as they recover, I can get out of my SM75 position for a profit, or I can sell that thing against it and get, a net neutral position. Like, diversifying is a great idea at its core. And then like Mike is doing here, like you can get active around that and like sell Apple calls against your long positions in stocks, or like my buddy in crypto, like on the way down there, buy Cardano like you want to, but also buy ETH, buy Bitcoin, and buy these other things. And now you're seeing ETH as the outperformer here on Monday afternoon. And it's like, all right, well, now I can sell out of that ETH position and translate it into Cardano, which still is having a hard time. Like, set yourself up for as many different ways to make money. And the best way to do that is to diversify across all the different asset classes. So thanks so much. You have any final notes? Anything you want to talk about the Bears, the loss over the weekend, or anything that's going on?
I'd rather not talk about that. No, they are pretty abysmal. But I was going to say, we're talking about like predicting the future and having these assumptions on the Tasty Trade. What I'm thankful for video, I did say that I would like to see Bitcoin at 100K. This was before this crazy meltdown. So that just goes to show, like, whatever my assumption is, like, could be totally wrong. But I did say I would love to see the Chicago Bulls win a championship. And the Bulls are live, baby. They are live. So we are headed directly into the Eastern Conference playoffs, and we'll see how far we can go.
Exactly. I was just going to say, we're a basketball town now, my friend. It is once again the 90s where we are basketball. We don't care about the monsters of the Midway anymore. We are a basketball town. And great example to leave on, which is like, I went to University of Michigan. I don't know if you knew that, Mike, but I would have, before the basketball and football season for U of M this year, I would have said Juwan Howard and the basketball team coming into the season ranked in the top 10 have a better chance at a national championship than Harbaugh and his like 7th year of trying to beat Ohio State. And I'm dead wrong. But good thing I'm long both of the Michigan teams, and I'm feeling great. Diversification, baby, helps out.
That's how you do it.
Absolutely. Thanks so much, Mike, for joining me here on Small Stakes. Again, you can go check him out on Twitter. He's great Twitter follow, great trader, just great person in general to be following out there if you're looking for both life advice and financial help as well. He's just been trading options, been teaching people about options forever. So we're so glad to have you on here on Mondays. And thanks everybody for watching. Splashing the Futures is coming up next. A lot of funky action in the futures markets. I'm sure me and Peter Momet are going to have plenty of trades. So stick around. Thanks for watching, everybody. Peace.